to be wealthy? Do you want to be in control of your finances? Do you feel like you mostly get financial advice from people who are trying to sell you a bank's products? If your answer is yes to any of these questions, then stay tuned because you are at the right place. Welcome to Money Convos, a club committed to helping people achieve financial freedom by providing education and guidance on personal finance and investments. We have a group of experts who share their knowledge and give practical advice with no strings attached. At Money Convos, we have candid, mature conversations about wealth, how to create it, grow it, and protect it. We share our experience and encourage our audience to share theirs and ask questions. Join us every Thursday on Clubhouse at 7 p.m. GMT. We also have book discussions that bring out practical lessons. So far, we have read Dumb Things Smart People Do With Their Money, The Richest Man in Babylon, and The Millionaire Next Door. Most importantly, we have one-on-one financial coaching sessions where we guide individuals through setting financial goals, retirement planning, budgeting, investments, risk management, and so many more areas. The goal is to get you to financial independence from whatever income level you're at. Follow us on Twitter, Instagram, YouTube, Facebook, and Clubhouse. The handle is at Money Convos GH, or send us an email at moneyconvosgh@gmail.com so we get you started on your journey to financial freedom. Now that you're all caught up, let's head into our next conversation.
Well, hello there, everyone. Hi, I hope you're all doing well. Hi, Jennifer. How you doing?
Hi, Likem. I'm doing well, thank you. And you?
I'm great. Great. So today we are introducing another book, and this is our first time on YouTube Live, not a test session, like a proper session. So the book is The Intelligent Investor by Benjamin Graham, set in the 20th century. I think this was the fourth edition. He revised it every couple of years, right? And one thing that's really newsworthy about this book is it is highly recommended by the man himself, Warren Buffett. And he wrote by far the best book on investing ever written. So it's been an interesting read for me, and I'm looking forward to sharing what I've learned from this book with everyone. Jenny, how about you? Initial thoughts?
Yeah, so Benjamin Graham is he's a force to be reckoned with when it comes to investing and giving investment advice. So I think he had a book called the Securities Textbook Analysis Textbook, and that's actually a textbook that teaches people like value investing and all of that. So I'm really happy that he sort of brought it down to the layman level for everybody to be able to absorb the information. I'm really looking forward to be talking about the stuff that are in this book. Yeah.
Okay, great. You say it's the layman's terms, and I get how it's lay, considering our CFA books and the kind of content and language in there. However, I think it's still a bit advanced to be not yes a bit advanced, and the language is suited to the previous century. So I'm really glad Jason Zweig wrote a commentary
Yes.
because that part is
Yes.
very helpful.
Yes.
Yeah. Okay, so I read the preface, I read the introduction. I know we had slated for the chapters 1 to 5, right? But let's see. I think I have a few things that are noteworthy from the introduction, right? And I think Warren Buffett wrote the
Preface.
preface. Take away his father, well, Benjamin Graham is the second most influential person in his life. So I found that quite interesting. Then there
Yeah.
was this part in there that said, when it was introducing the book, talking about what the book is about, and it said the book is about a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. Isn't it just interesting how emotions have come up again? Because I thought, oh, psychology of money, we are done with that.
Yeah, yeah.
Let's get into some hard numbers, right? Did you also get that feeling like, okay, here too?
Yes, here too. And I think the feeling has been going through, or the notion or that theme, the emotion theme has been going through all our books, from the dumb things smart people do with their monies to the richest man in Babylon. We've had that trying to get us in a certain mindset that helps us to become millionaires. So it really enforces the notion that you may know a lot of things, but if you don't have the right mindset to position yourself in a certain way, it's not going to work. So it really drums that theme home for me. Yeah.
Yeah, yeah, true. It's and yeah, all the books are saying it, and it really makes us realize that as human beings, we may think it's all about investing in numbers, but no, 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 no. It's really there's a factor to play, and that factor at play is our emotions and our ability to stand firm, to find good principles, good strategies, and stay firm with them. And as we get into the chapters specifically, we would see it come across more often. So let's get in there. Chapter 1 reads Investment versus speculation, results to be expected by the intelligent investor. And the author makes some comparison between an investment
Investor,
and a
speculator.
speculation, right?
Yeah.
Let me just read this. Let me read this part. An investor calculates what a stock is worth based on the value of its business. A speculator gambles that a stock will go up in price because someone else will pay even more for it. Wow. Investment is based on, that word is thrown about quite often, fundamentals, what the
Yeah.
business is actually about. And the speculator is talking about how much someone else will pay for it. So um, I'm not passing the judgment. In fact, the book, okay, I guess the book also passes judgment at various points, right? But I guess if you want to do an investment, this is what the book is saying. If what you are doing is more like you are trying to find the greater fool, someone who pay even more, or the last person holding the stock, well, the
Yeah.
speculation that you are doing, right? Any thoughts on
Yeah.
this distinction?
Yeah, it was really interesting because so we know that we have the, as Elikem said, the fundamentals, people who do check the fundamentals of the company to make sure that they are sound enough to buy them, and people who are just like doing technical analysis, looking at trends to see, oh, the people, it looks like some people are buying it, so this is a good time for me to get in and get out very fast and those things. And usually speculators are just in for a quick buck. They are just looking for some quick money. They don't really care about the fundamentals of the company. What? No, no. They are just looking to um, build up on, let's say, the day's demand or supply of certain things, and then make some money on it. But if you are, let's say, an investor, you should make sure that all you're aligning some three ducks in a row. And I like to mention those three ducks. Number one, as Elikem pointed out, you're supposed to make sure that you know a lot about the company and you've done thorough analysis. And you know that soundness, you can judge the soundness of the company based on what you found out when you're doing your analysis. And then you can buy the security. Now, if you've done that, then you must protect yourself against serious losses. And I like the way he said serious losses, because some losses may be inevitable, because some people are there who are speculators and who are just going up and down, and then the price will go up and down like that. But then you have to make sure that because you've judged the soundness of the company, serious losses are not going to affect you or your investments like that. And you must aspire to acquire adequate returns and not extraordinary returns from normal risk, or let's say average risk investments. So yeah, well, when you do these things, then you could be classified as an investor and not somebody who is just speculating on something to make a quick gain. Yeah.
You got my attention even more at the point where you said aspire to acquire, and I was like, okay, do we have some motivational speeches going on here? There's acquire to. You said, well, you should aspire to perspire to acquire something. Anyway, but yeah, what you said is true, and I like how you've laid down the three steps in there. So, do you mind just repeat those three steps so that our
Okay.
audience would note that down?
So the first step in the three steps that make you a good investor is to find out for yourself, analyze the company to find out if the fundamentals or the underlying business that the company is engaging in is sound and it is going to go on for the foreseeable future. So if you think that a company is good because their business that they are doing is good and it is a going concern, which means that it is going to go on and on and on and on, and they're going to get some returns from it, then you can decide to invest in the company. That's the first step. When you finish your analysis and then you want to invest in the company, you must deliberate. This is intentional. So you must intentionally protect yourself against serious to obtain adequate returns and not extraordinary returns for average risk. Yeah, thank you.
Okay. Great. Thank you for that recap. Okay. So you mentioned something about protecting yourself. And is that related to the emotions, as in not trying to chase after excessively high returns, or is it more about just take some risk management strategies?
I think it has to do with the two. So one is a defensive and one is an offensive.
Okay.
One is the I have to make sure that my emotions are in check. And one thing that is really important as an investor is to separate your emotions from a company. For instance, I am emotionally tied to a company. So if they're even doing badly, I can't see, or even if I can see, I am always defending them. And I'm putting my money there and putting my money there. When God forbids, touchstone, something happens, and then you are losing your money. Your emotions are not going to save you. It is hard facts that are going to be broken down at the time. And if your company, if your funds are not going to be reimbursed, then you are found wanting. So there's that part that you have to be able to separate your emotions from companies and look at them very objectively and make sure that if the return is too high, given its risk, then or given the underlying business that the company says they're going to put your money in, then you know that you have to run for the hills. Yes, so that's the first part. Yes, and then the second part, and could you please, remind me on the second part?
Was about risk management. Is it about risk management?
Yeah. So you see, I was having a conversation, I think 2 days ago, where I was telling somebody who was spooked with equity investment some time ago, and I was telling her that you need to have adequate risk management because number one, if you are doing pure investments, so let's say some two companies move together, we call them, they are positively correlated. So let's say if something is happening, if they're in the same industry and something is happening to them, they are all going to fall. For instance, I don't know if you remember space to space. So
Ah, yes.
time that space to space was very prominent. Like you get to the junction, and then there are almost five people or places that they are doing space to space. So let's say you invested in three companies who were doing space to space, and now the whole industry collapsed. That means that your whole, even though you've sort of diversified in three companies, your whole money is gone. But then, if you diversify your your investments across a lot of time places like industries and companies and all of that. It is you are reducing the risk that something happens and all of them will be negatively affected, such that you will lose all your money. So let's say we recommend that you do some, let's say you invest in some space to space, you go invest small in, let's say, this is very basic, so I'm not using any high level investments. You go and invest somebody who sells, let's say, some Sobolo or some Burkina, and then you go and buy some GCB shares. Yes, this is like I'm just talking about diversification so that you are reducing the risk that if something happens, all your money goes off. Yeah, thank you.
Okay, that's great. That's great. So, you're addressing the first part of it. You mentioned a few things which I'll just touch on, where we talked about you, like what you were telling someone, it's, you should manage how you react to some of these things, right? And the book again says the investor's chief problem, and even his worst enemy, is likely to be himself. The fault, dear investor, is not in the stars and not in our stocks, but in ourselves. So again, the psychology is playing out some more. I just also highlight on something else you mentioned, that was defensive versus the enterprising investor. The book distinguishes these two types of investors, and this is how it's described. The two kinds of investors to whom this book was addressed: the defensive and the enterprising. The defensive or passive investor will place his chief emphasis on the avoidance of serious mistakes or losses. His second aim will be freedom from effort, annoyance, and the need for making frequent decisions. That part, the need for making frequent decisions, you want to avoid that. And I continue. The determining trait of the enterprising or active or aggressive investor is his willingness to devote time and care to the selection of securities that are both sound and more attractive than the average. So that's the distinction between the two. There's one that is um, defensive or passive. I think passive is a
Yeah.
more popular term, where
Mm-hmm.
you want to avoid having to make a lot of decisions. But your main issue is you want to avoid making serious mistakes or losses. Then the enterprising investor, the active or aggressive one, is he's willing to put in the time and care to select as investments, with the hope that the person can pick more attractive stocks that will be more attractive than average. So that's another distinction the book gave us. And that's these distinctions have helped us understand the difference between investment and speculation, and then the different types of
Yes.
investors. All right, so we can then move on to the next chapter, chapter 2, where we are talking about the investor and inflation. We just can't run away from inflation now, can we?
At all. At all.
On our Thursday conversations, 2 weeks ago, we mentioned inflation. Just this Thursday, inflation came up again. I hope it doesn't come up again in the next Thursday
You
conversation.
probably will. Let me tell you.
It's like psychology and inflation. We just can't escape these two, huh?
No, 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 no. You can't. You can't.
Okay. All right. So perhaps, Jenny, you want to give us a quick um, a quick definition or explanation of what inflation is?
Okay, so I want to start with an example.
Okay.
2 years ago, or even a year ago, so I live at Agboba. A
Hmm.
year ago, from my house to the Atomic Junction was 2 cities. It
Is
went
that
up
petrol or taxi?
taxi. It's a short
Okay.
distance, so yeah, taxi. Yes. It went up to 2 cities, 60 pesos. And
Mhm.
as I'm speaking with you, a year later, it is 3 cities, 50 pesos.
Wow.
And like it's not funny. So inflation is when the for the same item the price goes up. So let's say
Hmm.
for one ball of kenke that at first was 1 cedi 50 pesos, now it can only be purchased for 2 cedis. The same size, nothing has changed in the size. The price has moved up, and this is as a result of a lot of let's say demand, or a lot of people chasing after the commodity or the kenke, but then there are very few people who are selling the kenke. So because of the shortage, the price will go up. Now there's also the this one is when for the same thing the price has gone up, and also there's the part of the money where you have less 100 cedis, and the things that 100 cedis could purchase 2 years ago, best believe 100 cedis can't purchase those things in some time to come. And the difference between the things that they could purchase 2 years ago and the things they can purchase now is the fact that their prices have moved up, and so there's inflation. So let's say the terminology will be that inflation is the increase in prices as a result of um, increasing demand for a good, contrasting it with a reduced supply of the same commodity. So yes, that is an overview of inflation.
Thank you for that. I want to put the numbers you gave in your example in perspective. So you said 2 years ago it was, is it two cities, 20
Two cities,
pesos?
two cities,
Just two cities flat. Wow. Okay. And
flat.
then a year later it was what, 2.2 cities, 60 pesos.
No, so in the same year, it has gone up twice, and probably
Oh,
will go up
okay.
by the end of the month,
Wow. So I,
because I can
if,
can force it going on. So we have the two city 60 pesos. So let's say in the 6 months it was two city 60 pesos,
uh-huh. So
and
that
then
means it went up 30% and then again 35%. And then we are even
wow,
anticipating that with what's going on in Ukraine and Russia, in Ukraine, fuel prices are going to go up further, and then the prices will
yes,
go up even
also
further. It
from
and
here to account.
just such a short distance, right? Such a short distance.
Yes,
And when
yeah,
what I'm even trying to highlight at this point is we usually have a general inflation rate, an average for the whole country, based on a
mm,
basket of goods and services that people generally purchase in our economy. But everyone's experience will be different. Not everyone will buy everything. Some people buy more or less of something. So just this. I think for 2020 the inflation rate was I think it was single digits, probably a little under 10. I think 9.7 or so. Not too sure. And then
mhm,
2021 it was ending at 12.6.
mm,
That's the average. But now we are looking at a situation where these numbers that we are talking about right now, the experience for one item is 30% and 35%. It's just crazy, right? So inflation will come and erode the value of your money. You had
yes,
100 CDs that you were going to spend a week on transportation. Now you will need even more to spend. Maybe one CD, 150 CDs a week. That's more money. Your salary is fixed, and so your what's left for you to save would be gone. So when we are thinking investments, we really need to take a keen interest in inflation, right? Another
yeah,
reason why we need to take a keen interest in it and tackle inflation, or how we should even tackle inflation, is that we should look at the interest we are earning on investments. So in Ghana, with such high inflation around 12%, 13%, the onus is on us to make sure that we are putting our money in investments that are earning way more than 12, way more than 13%. You should
yeah,
be earning 15% or more. So if you are leaving your money in your savings account where it's not earning any return for you, there's a bit of a
you're
problem.
right. Yeah,
You're losing value, right?
yeah,
Then
you're right.
so you know on the back of all this, let's see what's the book saying about inflation and how we should tackle it, right? And normally, we as investment professionals will tell our clients that then you should get an investment that over the long term can provide you much more return, and that will provide a sufficient buffer, a sufficient cushion against inflation. So we normally say stocks. But it's an interesting angle how the book went. Yes, stocks are good, but guess what? Stocks fluctuate. And sometimes, based on when you get in and when you get out, you may have a different experience from someone who may have stuck in there for 10 or the same for a 10 or 15-year period as you also did. Just that the person started and ended at a different time. Gets a different the person will have a different experience, right? So there's
Mm-hmm.
still that level of fluctuation. So you are not guaranteed that while you are in the stocks, you will have a hedge against inflation. So we mentioned that bonds have more certainty in their returns. So now you are looking at inflation around 13%. In a Ghanaian context, you could look at getting a 5-year bond, and I've seen a notification this year, this week, that's in the we are being 7th March. This week, the government is going to issue a 5-year bond. So I can imagine what the return will be on it. But judging from the bond
Mm.
ramps, what's going on, I'm thinking we are looking at 20-21%, right?
Yeah.
You can lock if you lock in that 20-21% over at least over the next 5 years, you have you just keep praying that inflation doesn't cross 20-25% so that you are
Wow.
protected. At least it gives you that certainty. With stocks, though, it may work out that even with the stocks in that same period, annualized return may be 30%, 40%, 50%. But it may also be 0% or even
Yeah. Or
negative
even
5%.
negative. Yeah.
So yeah, it's the key takeaway for me for that chapter was yes, inflation is important, but be careful how you hedge it. Stocks may not be the be all end all to solve your problem. What do you think
Yeah.
about that?
This is really true. So in 2018 to 2020, the Ghana Stock Exchange didn't do so well. For some of those years, it was negative. So I was just wondering one time that if, for instance, you have an investment that you've bought, let's say, some shares, and then you've gotten, let's say negative 5% that year, which means that effectively if the inflation rate was 10% and you also got negative 5, the real loss on your money is around negative 15%. And this makes it very like it breaks it to your face because shares can do the Ghana Stock Exchange has done 137% before in one single year. So if one like it is doing 137% and inflation rate is 10% that year, like what is it, we are I don't know the word, like is it quintillion or what, we are doing that to the inflation rate, but then it is not certain. That is the whole point. You can't back on the stock market to say that this will provide me returns that will supersede the inflation rate of that year, and so I'll have let's say some more money than what my inflation eroded from my investments. And so we hope like you use the bonds as you said, Elikem, and then you lock in some rates that is quite further from the average inflation rate and hope to God that the inflation doesn't creep up high and even erode that one. If you are still a stock person, I would recommend that for you to hedge inflation, you could look at a combination of the two, bonds and then equities, so that you can still rest assured that the bonds are serving you some purpose when times are bad, but then when times are good, equities are also having your back covered. Yeah, thank you.
Yeah, voila. A nice balance of the two to meet all needs because inflation is not the only thing you're trying to
Problem.
is
Yeah.
not the only goal, right? So a good balance of stocks and equities, stocks and bonds in your portfolio. Great. All right then. Let's jump to chapter 3. And it says a century of stock market history. And the author Benjamin Graham went on explaining the certain phenomena in the stock market, and it was quite an intensive, detailed read, right? And especially with the context of having done many reviews over the years, and this book is a fourth edition, so
Mhm.
it gives a lot of context, and then the commentary also comes, to make it more current for us. I think Commentary was written in 2003, right?
Yeah.
Yeah, I think it was written in 2003. So that gives you some more idea of the timing. And I find it interesting what the conclusions are or the lessons are from considering a century of stock market history. The Ghana Stock Exchange has what 96 to now. That's what 26 years of
Yeah.
history. Fine, we are quite young. We still have a long way to get to a century. So we then consider what the US market where they have had more history, right? And some of the lessons in there remind me of what we read in the psychology of money, and it
Money.
says, you know how it was talking about history, that if
Yeah.
a lot of, okay, let me read this part so that you get it. The heart of Graham's argument is that the intelligent investor must never forecast the future excessively by extrapolating the past, right? And I just want to even add on a little bit. It says, unfortunately, that's exactly the mistake that one pundit after another made in the 1990s. And it's like we keep trying to use the past returns to forecast future returns.
Futures.
See,
Yeah.
oh, if this has, if it has, this has happened in the past, then it's likely to happen again. But the book Psychology of Money put it so eloquently. If history, if we could use history to predict the future, or if history didn't repeated it, yes, if history repeated itself so much, then we wouldn't even have the subject history, right?
Yeah.
So yeah, it's just interesting how this is coming up again. What do you think?
So I like the way all um investment books give you facts about historical returns so that you see what's going on the ground and your head won't be filled with cotton thinking that everything is rosy. Yeah, so I like that component that they all bring. And another thing is that I like the fact that this came early because he's letting you know that it's not the stock markets most of the times are even declining. They are there's volatility and there's everything. And one thing that he said that caught my eye was that usually the there's no augmented when you're comparing it with the bond market, there's no serious growth in okay, there is, but it's not as big compared to the increase in the bond market. The equities market has not grown as big, and it tells you that a lot of people are not value investing or like investors. They are mostly speculators, and they are just in and out making a quick buck and going to lock it somewhere. So he made an example that let's say you get some returns or you get some capital gains, which is you buy a security at let's say 5 cities tomorrow, or in 3 years or 5 years time you come and realize that the security is 10 cities. You've made capital gains of an extra 5 cities. So that's extra when you take out your money and then you lock it, then you go and put it in some bonds to guarantee your returns for a while. So it's like a speculative yield. And then he said again, for what Elikem said about the using historical performances to um, predict future performances. Usually returns have three components. They have the growth, the real growth, which is the rise in the return that will be given by the fundamentals of the company. So the um I'm trying to put it in normal words, like the value you get from the company itself. Yeah, so that's the real growth. And then we have the inflationary growth, and every investor usually wants to have some support or some backing against inflation. So they have that also tacked little to the return that you are getting. And then there's a speculative growth that is what people are thinking the stock will go, and then the demand that is driving it. So usually returns are made up of three components, and the speculative is the only part that's basis on historical performance. People are looking at past results to predict the future, and it forms 1/3 of the whole return of a company. So if you're only basing on historical performances, you're getting 2/3 of the whole equation wrong. And so you don't base on that to do that. You do your analysis and put in some aspects of the fact, put in some margin of error, signaling the fact that speculative investors will do their thing and you may move the prices in one direction or another. Yeah.
Yeah, yeah, good point. And I would even want to speak a little more on the other one other part of the three parts that you mentioned, where it's talking about the value you are getting from the actual business. And the author says the value of any investment is and always must be a function of the price you pay for it. Because when you do a good analysis of the underlying business, and perhaps let me just break down what I mean by this. Let's say someone says, invest in my business, and you go like, okay, what business do you do? I sell fruit juice. Okay. How much fruit juice can you sell in a year? And you say that you can sell 100,000 CDs worth of fruit juice in a year. So that's your revenue. You take out all your costs, and what's the profit that will be left? 20,000. So a 20,000, 20% margin. So leave you with 20,000. How much of that will you be paying out as dividends? And so you are starting from the fundamentals of the business. Is the business solvent? Would they be able to pay all their creditors? All that. That's a good basis to start your analysis. Check if this kind of business, the fruit juice that they are selling, is so unique and people love it that in 5 years to come, they will still be selling. Are they able to innovate, right? So those are the things to consider. However, what this chapter is talking about is people are not looking at these kind of things to understand the actual business. Rather, people are focusing so much on the price movements. And what they are doing is that because of focusing on the price movements, they are missing out on the fact that one day there will be a bubble, and that bubble will burst. Everything will come crashing down like it has done it many times in the past, and you'll be left holding something. I found, perhaps not in this chapter, something interesting later in the chapter when the in the 2000s, after the dot-com crash in 2000, this book was referring to how people were holding Amazon. And well, I'm sitting here 20 years later saying that, okay, this, the first lady hadn't sung yet, so perhaps the
Yeah.
author jumped the gun saying
Mm,
that Amazon. But you remember, was it last week? I reminded you of what this man, Jeff Bezos, said that the stock price is not the business. You see, people are trading, selling out of it. No problem. It is
mhm.
not the business. In fact,
Yeah.
in Ghana, I dare say MTN is an example of that. But hey, this is no investment advice. MTN
Yeah.
Ghana is you see a lot of activity when the price was going down. People were selling it, and a major reason is a lot of people were in it, and it's one of the most liquid stocks. Cowbank is an example of
Yeah.
such a stock where people you if you follow the short term how people are trading, you think, oh wow, a lot of people are just selling. So I'm also going to sell, I also get out, or a lot of people are buying. But that's the thing, it's so freely available that's what people are trading actively. There are many other stocks that people may should want to pay attention, but it's not liquid. They are not enough to buy or sell, so
Seven.
people are not paying attention to it. So if you don't focus on the actual numbers, you just be deceived either to buy or to sell at the wrong time. Yeah, I guess the last thing I would say on this chapter is the book reads, the only disputable truth that the past teaches us is that the future will always surprise us. Always. Isn't that just an interesting point?
It is. And I think COVID always brings this point home because at first, if you've done your model, macroeconomics, blah blah blah, even this Russian-Ukraine conflict is an anomaly that couldn't have been predicted by historical happenings. So yeah, we are in for a lot of surprises, which makes me wonder what will come next. Yeah, because we are just in March. Yeah.
I know, right? But anyway, let's not jinx it for
Yes.
nature to go like, oh, you've not had enough. Okay, bring it. I'm gonna bring it on. But there's this saying I like, and I guess after many years of of being in the investment field, and I've appreciated risk and uncertainty. There's this saying I have that the only thing guaranteed in life is the fact that nothing is guaranteed. So yeah, okay.
I
If you've
think
not
I've heard
heard
a
anything,
variation of that. Sorry, I've heard a variation of that which says the only thing
uh-huh.
guaranteed in life is death and taxes.
Yes, yes, true. Death and taxes. But even that one, crap, based on your faith, with the death based on your faith, perhaps you come and you come and
Uh,
you get raptured or something, right? And
yeah, yeah,
taxes to Charlie, there are some nefarious
precisely.
characters who are not paying taxes
Yeah,
too. So
yeah,
anyway, anyway, so let's jump then to chapter 4, and it's talking about general portfolio policy and focusing on the defensive investor. I observed that this chapter was mainly about rebalancing your portfolio, and it's interesting, especially if a Ghanaian reads this. Ghanaians, in my experience, don't like to take on too much risk. We want to play safe but get the highest of returns. You want
returns.
someone to guarantee the return and let it be high. Granted, well, if the government is issuing bonds at 20%, they are going to crowd out everyone. So you can just imagine. You have to offer way more to get their money. But
20 to 7, yeah.
yeah, but anyway, that's a fight for another time. So we want
Okay.
we have been so used to fixed income, safer investments. They bring your principal, get interest, fixed deposit, treasury bills, treasury bonds. So and we are getting well rewarded for it. So not a lot of people play in the equities, and someone would even say that when they want to play in equities, they are ready for it, but they come 6 months later, the value they've lost, their 1,000 CDs is now 900 CDs, and they are freaking out, raising hell, pay me my money. We don't have the heart for it. I think collectively, on the average, it's safe to say that Ghanaians cannot stomach so much risk. So reading
Yeah,
this chapter, people go like, you are saying that at a minimum, I need to have at least 25% equities in my investment portfolio.
yeah, yeah.
It's shocking to people. Have you also observed this about Ghanaians?
Oh, I am one of them. Okay, no, so I don't actually like risk. I don't, I have just a very small percentage of my total assets in equities
Mm.
because I can't stomach, and also because I work at an investment bank, I am privy to the happenings of the industry. So when it's tumbling, I'll just be thinking, "Hey, my money." Yes, and I don't like that so much. So I have a very
Okay.
very small percentage of my whole assets in equities, or let's say an equity investment fund or something like that. Most of my monies are in fixed income securities. So I think I'm not as bad as Mimi straight. Sorry. But then
Make
I
a
am
stray
also
bullet.
typical. Yes. I am also a typical Ghanaian. But then there's the part where um people do not want to take risks, but then they want returns, like high returns. And I think that is such a a serious thing about Ghanaians because we are we are used to people guaranteeing returns. Number one, we are used to people guaranteeing returns for us, and so when anybody comes to say that, "Hey, I can't guarantee returns," it's almost as if you, Mumna, you are straying from the norm.
Mm-hmm.
And because of all the issues that have come up, if somebody says, "Oh, I'll give you 30%," it's almost that that certainty is transferred to the client. So sorry, I'm come to say this in she also we need not me about will be so mommy 30%, something like that. But then they don't know that me telling you is very different from you seeing the thing physically in your hand. Yeah. So it's very serious about that. I want to just go on and say something little about what I think about the chapter. And you mentioned something about the 25%. So I liked it when he said that conventionally, and this is very conventionally, in quotes. It doesn't mean that it is applicable to everybody. No. So conventionally, you take 100 and then you subtract your age from it. When you subtract your age from it, what is left? You put it in equities, share, which is stocks. Which means that if I am currently 90 years old and I am subtracting my 90 from 100, it's just 10% that I can put in shares. And so you can almost hold a fixed income portfolio. But then it is just going to show that if you are young, you have the option of taking on more equities because you have a lot of time ahead of you before you even reach retirement. So me like this, that I am 18, I will have I will have a lot. Yes, please. I'm forever young. I will have a lot more.
Okay.
A lot of like 82% of my portfolio in equities, and then the rest distributes among fixed income securities and then in cash. And it will help me tide over for the time that I get there. But then if you're also 50, then look at the dynamics and see that this is what you can stomach in this asset class. But apart from this, there's also the dynamics of, are you single? Do you have some, let's say, some things that you are paying that always takes a chunk of your money, blah blah blah. You need funds. You do a lot of withdrawals and all of those. You have to factor in all of those things before you like constrict yourself to a part of investments. So then, let's say, for instance, you have an ailing mother. You are quite young, but then you have old parents and their age is catching up with them. They get sick and all of that. So you do a lot of withdrawals from your investments to cater for them. You can't stock your funds in equities because you do a lot of withdrawals and you may sell out at a very low price. Yes. So you need to put all of these things into consideration before you plan out your portfolio. And an intelligent investor takes all of these things into consideration before they make a decision. Yeah.
Yep. An intelligent investor takes all these things in consideration, your unique circumstances. And these are some of the things that make uh, conversations with clients seem tedious to their clients because it's like, "Ah, just tell me how much return I'll get." He said, when I invest, how much money, what will I get? 10%, 20%, even if it's 1%, you just tell me. But you're asking me all these questions. I'll take my money
Questions.
elsewhere.
I know. I know. Hmm.
But I think it's interesting. I'm really contrasting the Ghanaian context to the American, where I think their market has developed far enough for them to appreciate some of these things. They don't just jump to what return will I get. They don't expect it to be guaranteed. Compared to Ghanaians, where we want a high return and we want it to be guaranteed. So
Yeah.
yeah.
Yeah. I just want to say something small on this. Ponzi schemes are a Ponzi scheme is an English word, which means that it came from the US. Like there was an instance of it in the US that they were able to give it a name. You understand? So I feel like they are past a certain place, but we are now
Mhm.
getting to those places. So we
Yeah.
are now learning the things that they've already learned and then they've gone past. Yeah.
True. I I think I was just looking up Ponzi scheme and it came up from there's someone, it was originated from someone who actually
Charles
his
Ponzi.
surname was Ponzi.
Yeah, Charles
Yeah.
Ponzi. Yeah.
Ah, voila. Okay. So just a little more to add on this chapter before we move on is the book is advising a range of equities in your portfolio. That's 25% stocks if you are not too risk seeking, if you can't stomach so much risk, just do 25%. Then, if you can take a lot of risk, do a maximum of 75%. And it's interesting when he's saying that even for someone who can take on a lot of risk, don't do an entire 100% in stocks because it will
Equities.
help you when you have that cash portion or that bond portion to actually stick to the equity portion. With equities, it will go up and down, you don't want to be caught out because look, you may put all your money in shares, but you may just fall sick and you need to
Pay for
cash out
something.
and pay for
Yeah.
something. You get it, or you may lose your job, you may get divorced or something. You need money, so instead of you having to sell your shares, at least if a quarter of it is in something safer that you can easily liquidate, then you'll be fine.
Yeah.
So there's that. Then a key thing, the book didn't mention this, but I think it's important, especially for Ghanaian investors, is let's not operate with mental accounting. I explain. The normal Ghanaian investor doesn't like to let people know too much about their finances, and sometimes it also comes from a good place. Another reason why they would have, okay, I'm beating about the bush. Ghanaians have multiple accounts. Let me start from that point. A lot of Ghanaians have multiple accounts. All right. And what are some of the reasons why we have that? There are multiple accounts to meet multiple needs. So you
Needs.
have the project account to build a house. You have the
Yes.
children's school fees account. You have the emergency
Yeah.
fund. I hope they have emergency
Yes.
fund. Then
Yes.
you have can you mention any other types of accounts
Retirement.
that people, retirement
Retirement.
accounts?
Yes. And then
The
just a B fund for Shege retirement reasons
Sige
for
reason.
yes.
Some people who even wants a good life crowd have the travel account.
Yeah.
A whole
Yeah.
lot of different stuff
Entertainment.
for
Yeah.
some for home maintenance and all that. The reasoning behind these are all important. And sometimes it's even just sometimes you also want to put them in different places to not put all their eggs in one basket, right? Separating them helps you to make sure you don't go and spend money that's meant for
Yeah.
something
Mhm.
all well intentioned, okay. However, I think this book is talking more about our investment portfolio. So there are two ways you can look at it. The accounts that you are going to you have your core accounts, the emergency fund, the all the accounts that you intend to use the money for expenses in future, maintenance, education, all those things. Fine, separate them. Now let's talk about your actual investment account, where you this is meant to build wealth. This is not the money that you are saving
Going to pay school
to
fees. Yeah.
exactly, or even build a house or something. I think those ones should be kept separate. And think about your investment portfolio, just money that you are growing, that you may not have a specific need for it. You may now this the key punchline. Even if you keep these monies in separate accounts in different places, have an Excel spreadsheet. Name them: account in Stanbic, account in EcoBank, account in Data Bank, account in this. This is how much I have. Have a total.
Indeed.
Then classify them. This one is equity. This one is bond. This one is equity. This one is bond. And then after all is said and done, see, look at it and say how much of your total, if your total is 10,000, how much of your total is invested in stocks or stock mutual funds like EPAC, so that when you add your EPAC, you add your balance, your EDC balance fund, you add your MTN shares, when it all adds up and you realize that, oh, it's only even just 5% of your total investment portfolio, then you realize that you are not doing an optimal thing. It's just I'm just hammering on this because I find that it's quite a struggle for a lot of Ghanaians to think holistically about their investment, because we scatter things and also we are not open to telling an investment advisor or where all your money is. Maybe they'll go and tell you to disinvest and bring it to their investment house. So anyway, free advice. Okay, let's then jump to the last topic, the last chapter we are considering this week, and it's still on the defensive investor, the passive investor. So it says the defensive investor and common stocks. I I observed from this chapter that it was talking about various strategies that you can do for investing in common stocks.
Investment.
One was
Yeah.
dollar cost averaging. Common stocks is another word for shares, equities. These words are all just used interchangeably, right? So there's dollar cost averaging. There is diversification was also talked about in this chapter. Um, but I'll just mention something from the top of the chapter, and he talked about the reason why you should, or the benefits of having equities or stocks in your investment portfolio. Two main reasons. He says the first is that stocks offered a considerable degree of protection against the erosion of the investor's dollar caused by inflation. And further, it's explained that because over time it had provided much higher return, that's why it's overshadowed inflation. But remember earlier on we said that it's not guaranteed.
Yeah.
Then the second benefit of stocks is that they provide, again, higher returns to investors, especially when you compare them to bonds. Bonds, you are looking at certain fixed return. For example, last year bonds were doing around 5-year bond was doing around 17-18% in Ghana, whereas the Ghana Stock Exchange did, what was it, 40 something
Yeah.
percent,
46, yeah.
46%. So for just 1 year, granted, just 1 year caveat, if you have to do a um,
Analysis.
longer horizon to do a better comparison, right? But that's the opportunity that you have with stocks. So stocks are good, I guess. But for someone reading the book at this point, you've already established that if you want to take on risk, stocks can give you higher returns. So we are past that. So strategies in there, dollar cost averaging. Jenny, do you want to say a little about dollar cost averaging? How we can do it simply?
Okay. So the dollar cost averaging was to buy, like an example is to buy a fixed amount into, let's say, a fund every month as a defensive investor. So for instance, you you want to buy, let's say, M fund. I want to use, so we have in, they use index fund in the book, but I want to use a mutual fund in Ghana, for the example. So for instance, instead of putting 12,000 CDs at one time, bam, in M fund, dollar cost averaging um explains that you should be putting like periodic, or let's say, okay, so periodic, maybe monthly deposits into the, let's say, the same M fund. So let's say 1,000 CDs every month. So 1,000 CDs every month, like that, for the same 12 months, making the 12,000. It helps you with spreading your yields. Like, you get yields across the whole year, because for instance, if the returns in the year were very good in January, but then your 12,000 didn't come in January, your 12,000 came in December, you are losing all the rates that you could have gotten from the first month of the year to the 11th month. And so instead of the small deposits across the entire time, that one you are spreading your money across all returns that come. So you are going to get returns from all aspects of the investment curve. And you're also building consistency, because one time 12,000, yeah, a lot of people can do that. But for you to sit down and every month, or however frequently you get your money, put in some money in, let's say, a mutual fund, will, over, let's say, a 10-year period, a 20-year period, it's going to help you build that discipline and consistency on top of the returns you are going to get. Yeah.
Great, great. Thank you for that. And there are ways these days, there are ways you can do that automatically. There are words
Yeah.
like, you've probably heard of direct debit, standing order, where the money will be moved from your main bank account, your current account or your savings account into your investment account on a particular day every month, and it will just be invested for you. So I strongly encourage everyone, talk to your wherever you invest, see, try to get that done. And like Jennifer was saying, what is important is that consistency, that habit. It's easy to say, oh, I want to put 100 CDs, but 100 CDs is just something small, and then you skip it this month, you skip it next month. But compounding interest, when it comes to investing, you think about what you can control. And what you can control is how much of your income you're able to save. You could be earning a lot of income, but if you don't build that habit, you won't put that money away. So how much you can save? You really can't control interest rates. You say, oh, you chase high returns. You get bent. In 2018, 19, financial institutions in Ghana were closed down and people lost their money. So you don't want to be in that kind of situation where you chase returns and you go for men's gold and say that 120%, effectively 120% a year, and you lose all your money. You don't want that kind of situation. So do it small, 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 build that habit. And it's not even about you writing a check or going to take the cash and go and put it in the bank. Automatic is transferred. And another benefit you get is you don't you don't try to time the market. When it comes to stock investing, a lot of people will say that, okay, I think this stock is good right now, so let me buy it. A lot of my clients ask me that, so what's hot now? Bruh, bruh, calm down, calm down. You want to invest, you bring the money, we'll invest it for you. All right. Don't be so fixated on what's hot now. You consistently invest every month. Now, it's one of two or three scenarios. Either first scenario, things are flat, nothing's happening. Well, you have the same 100 cities is buying the same number of shares. If things are down, if things are up, at least you realize that you'll not be thinking counterintuitively, because when things are up, you're in investing, you're supposed to buy it when it's low and sell it when it's high, But funny thing is, people get in when it's high because, oh wow, there's a lot of momentum. Everybody's talking about fan milk doing 300 plus, Bob doing 300 plus. Everyone wants to get into fan milk, but that's the wrong time to buy. So
Yeah.
you end up realizing that you are still buying the same amount, but if you had left it to your own devices, if it were 100 CDs you were doing every month, perhaps you'd have said, nah, this time I'll do 1,000. Fan milk is doing well, but it helps keep you in check so that you don't misbehave. Then now, even on the most positive side of things is when you realize that because the price has gotten down and you are still doing 100 CDs, you are going to be able to buy more of it. So if the shares was normally it was 10 CDs per share, you could have bought 10, right? 100 divided by 10, you could have bought 10. But now because it's gone down, it's 5 CDs. Now you don't get to buy only 10, you actually get to buy 20. You double what you are getting so that when it recovers, you are even holding more, So that consistency, and it helps your mind stay in check. You don't misbehave and trying to buy and sell fast to time the market. It won't work out for you. Okay, then another thing that was mentioned, diversification. In the Ghanaian context, I would strongly encourage you not to, unless you are so savvy, not to go directly into the a lot of direct investment in shares. But if you still want to do it, you could diversify. And the investors, if you have in your portfolio 10 to 30 stocks, that would provide you sufficient diversification. So minimum of 10, maximum of 30. But guess what? You don't even have to worry so much about it if you want to go with a mutual fund. A mutual fund, you bring your 100 CDs and then it will come and join some millions and they diversify it across for you. Instead of your 100 CDs, you're now going to take, okay, they said 10, okay, so that means 10 CDs. Can I buy MTN 10 CDs worth? A broker will look at you like, what you talking about? So you don't even have to worry so much about that. Do mutual funds and you'd be fine. So yeah, those are the lessons for me from chapter 5. I could add on a little more, but hey, Jenny, do you have
I
any
have one
more?
more. Yeah, so I just want
Great.
to harp a little more on the diversification before I go to another point.
Okay.
See, like you can't fail with diversification. Apart from the compounding interest, that is the seventh wonder of the world. Diversification is probably the eighth wonder of investing. Like you cannot, because you can't.
Well, Jenny, you never say can, right? And never say you cannot, right? Never say never. But let's
Yes,
say
never say
highly
never.
unlikely.
Highly unlikely. Okay. You see, the thing about investing in companies is that you can do your analysis, but you're not at the helm of affairs in the companies. The people may take decisions that you may not agree with, and it may cause the company to collapse. You don't have direct control over what other people are doing in their companies. So for you to hedge against the risk that they may be doing something that will go against all rational like beliefs and that will cause the company to fail. And we are human. Like, even though people are very educated and all, things come up, situations come up that people will not be able to swing the tide around for their behalf, and then the companies collapse. Because of that, you need to spread your risk across companies, across industries, so that if one thing is going down, even if the other things don't come up like a swing and they stay flat, it's not all your pot of gold, for lack of a better word for investing, that is going to go, but it's just an aspect of your pot of gold. And let's say for your half a loaf to, no, not half, let's say a quarter of a loaf to vanish, then the whole bread vanishing is very serious. So yeah, diversification cannot be overemphasized. Yes.
Exactly,
And,
exactly.
hey, where is that guy who is safe for the vanishing? Yeah. And anyway, it just came to my mind when I was saying this. Another one is that so the books talked about the home bias. Home bias meaning, let's say a company is from. Let me give you an example. This is not investing, but it will probably drum it home for you. I come from the Bongahafu region, and Ebony, may her soul rest in peace, was from the Bongahafu region as well. So I liked her when I heard her music the first time. I was like, oh wow, this is somebody that's her style is different from what was already in the public. So I liked it. And then I heard that she was from my town. I was like, oh, if we fear there, then it's good. So I was listening to her songs, like I was really spreading the word that, oh please, we come from the same town and those things. We have that same bias when it comes to investing. Oh, a company that is from, let's say, your village or your town or your country, you will really think that, oh, you know them. When I go to their parking lot, so many cars, people are buying. You think you know them. If you don't look at financials, you don't know them. If you are just looking at the people at the parking lot, people in the browsing the aisles, it's not a judge. Or you say, oh, I know the CEO, he's my father's friend. No, it's not a judge. You are supposed to look at all of these things very, very objectively, and not use that, oh, I know the person, I know the people at the helm, I know this company, they started in my mother's basement. No, no, all of these things are supposed to be constant so that it doesn't lead you astray. Yes, please. Thank you.
Thank you, Jenny. You touched on something that was going to be my closing remarks for this session, right? And it's on familiarity. It's in investing we realize that familiarity breeds complacency. That's a lot of R's and L's in one sentence. So familiarity breeds complacency, and you realize that when, like you said, people think, oh, they work in a company, and it happened with Enron, it happened with WorldCom, as the book referred to them. So if you're in a company where you have stock options. Perhaps you work in MTN or you work in Standard Chartered Bank or GCB in Ghana, and you think, oh, my business, my company is good, is good. Calm down. Think about it on your own, right? Have a diversified portfolio. Some people would say, and Jenny, we were discussing this in a
We've
car
had this
recently.
conversation. Yeah.
Yeah, about people who say if you are the CEO or you are a key member of staff, you don't have trust in the business if you are selling your shares or your options. But the fact is, as an individual, it is sound personal finance to diversify. So don't put so many of your eggs in one basket. You may know what's going on there, but guess what? You are not the CFO. Even if you are the CFO, you may not know what is going to
All
go
the
wrong the
decisions.
next month. You may think everything is okay today, but next month something could happen. A new law could come and say that you are now a significant market participant, or introduce an e-levy, and things are just going to go out of whack. All your calculations just go out of whack, right? So just don't be too familiar. And the last thing I'll say is, before you invest anywhere, you need to understand the business. You said it already. And especially when you want to look at investing directly in stocks, check the financial statements. understand what's going on there, come up with a good value for the business. Because you could say that it's a good business, but the price that you invest in, if you buy the shares at 10 CDs versus you buy it at 5 CDs versus you buy it at 20 CDs, that's how you're going to get your return. Don't just say, oh, everyone is buying. Because if everyone is buying and you buy at 20 CDs per share and at the high, and it only goes up to 21, then you are
Yeah.
getting only 1 out of 20, right? That's what
Yeah.
5 is that 5%, right? You're only going to
Mm.
get a tiny
No,
sliver.
1 out of 20 is 2%.
Oh, okay. All right. Look at that. So you're only getting such a tiny return. Or even worse, it may be overpriced and it will come down. I dare say, investing, you never know when the fat lady has sung, but at the point, MTN was trading at 1 CD 26 pesos. Now it's come back to around 1 CD. So if you bought into the momentum as everything was going up, maybe hang in there a little and see if it will come up again.
Yeah.
All right, all right. So it's been an interesting
Anything. Sorry,
conversation.
I want to give another example on this. When you buy something at too high a price, and then, sorry, just
Okay,
before
all
you
right.
wrap up. So, I read a story about, you see, auctions.
Mhm.
Auctions. People are mentioning prices, and then the highest bidder wins. So it was a horse, and apparently it was a prized horse, and it was a stallion. So people wanted to breed with their other with their, let's say, their female horses, which is a male, and the price was going up, and so then it wasn't about the intrinsic value of the horse, it was just the need to win, that at the end of the day you are the person who left with the horse. So people were putting up prices. The final person who won, after the adrenaline left, he was like, why did I pay so much for this horse? And sadly, the horse didn't perform as they thought it will. So yeah, it's even lost. Yes.
Wow, look at that. Wow, look at that. Ah, it's just sad. It's just sad how people don't give such things a thought or don't think about it that way. The basic
Yeah.
principles of buy low, sell high, we miss it. We miss
Yeah.
it.
And
Okay.
so I want to make a correction. Sorry, when I said the
Okay.
1/2 is 2%, please don't my credo. Please forgive me. It's actually 5%, like you said. Thank
Ah,
you.
yeah, yeah, yeah. My head no die like that.
I know your head
Yeah,
will
I
die.
will.
It's me that my head dies.
Okay, great. Thank you for the fact check. All right.
Yeah.
Okay. Thank you so much, Jenny. It's always a pleasure having these conversations. And at this rate, we'll be reading 12 books a year, right? So
Yeah.
it's always a good thing. And to our audience, hey, look, if you don't necessarily have to read the book to follow us, but I strongly encourage it. This book is a bit bulky, so at least even if you can read the commentary parts, you would learn a lot from that. So strongly encourage you to pick up the book, read it, or listen to us. Follow us on subscribe here on YouTube. Follow us on Facebook, on Twitter, Instagram, and replays just to keep you in mind, keep personal finance in mind at the forefront of your mind, so that on a Friday night when you are going to spend, you go like, you know what, wealth is a function of what I spend. I should not buy an extra bottle of or
Yeah.
a more expensive whiskey or a more expensive brand of drink. I should just go with what I need, right? Just it helps you to stay in mind. So just follow us everywhere on social media. It's at Money Convos GH, or send us an email at moneyconvosgh@gmail.com. And do join us on Thursday. Every Thursday, we are having our conversations. This Thursday, March 10th, we are having a conversation on Clubhouse. And even if you miss it, you can check out the repeats. There are links, so just check out our link tree. And this Thursday, we are having a conversation about loans, terms and conditions. The kind of mistakes people make when they have loans. So we are going to have that conversation. And next week it will be on mortgages. So we are getting closer to getting you your house, right? So yeah, do join us on Thursday. I hope we get to meet you over there. It's more interactive on Thursday, so catch you there. All right then, Jenny. I hope you have a good week. To everyone, to have a pleasant week, and catch you on Thursday and Monday. Bye. But
Okay.
I'll close with this
Bye.
ending stream. Bye.
Okay. Hi, welcome to Money Convos, where we discuss personal finance and investment tips. We're committed to helping people create wealth and achieve financial freedom. Follow us on Twitter, Instagram, Clubhouse, and Facebook, and subscribe to our YouTube and podcast. All right then, let's head into today's conversation. Thank you for taking the time to listen to our thoughts. I hope you learned a thing or two and start practicing. Don't forget to follow us on Twitter, Instagram, Clubhouse, and Facebook, and subscribe to our YouTube and podcast. Do tell a friend about Money Convos so we all become wealthy together. Talk to you soon. Bye.